Hello, my name is Julian Ramirez, and this is my managerial accounting individual project. I will be going over in this presentation the financial breakdowns of two publicly traded companies, in this case, Acushnet's Holding Corporation and Topgolf Callaway brands. First off, this presentation and its contents that are being shared are of myself and not any of my affiliates. Let's get into a little bit about the brands. So Acushnet uh, Holding Corporation is they are both golf brands. Um, with that being ticker symbol of GOLF. They are a brand that was founded in Massachusetts, and that is where they are currently headquartered in. They have many smaller brands under them, like Titleist, FootJoy, Scotty Cameron, Vokey Designs, and Pinnacle. Going to the other side into Topgolf Callaway brands, their ticker symbol is MODG, and it is two companies, Top Golf and Callaway, that merged in at the beginning of 2021, finalized their merger. And they have many companies as well under them, including Top Golf, Callaway, Travis Matthew, Top Tracer, Odyssey, Ogie, and Jack Wolfskin. Topgolf was founded in England and Callaway was founded here in Carlsbad, and their headquarters is still currently here in Carlsbad. So, are we going to talk about a little bit today in this presentation? So, we are going to go over many different types of ratios to compare both of these companies and see deep dive and see what really is behind these two companies. So, first, we will go over some liquidity ratios. Then we'll move over to some profitability ratios, then followed by some market value ratios, then some leverage or coverage ratios. Then we'll go over a little bit about the DuPont analysis, and finally wrapping it up with a little bit of the Alt and Z score. Let's jump right into the liquidity ratios. So I picked two ratios within liquidity, which I thought were the most important to my two companies, and it is the current ratios and the quick ratio. So a little bit about the current. I believed it was important because it shows whether the companies have enough current assets to cover their short-term liabilities. So in this case, like if we look at MODG, they have like an upwards trend from 2023 to 2024, meaning that they have more assets and less liabilities, which is good compared to like golf, where we see a little bit of that decline, where they might have a little bit more of those liabilities. And I picked the quick ratios because it provides a stricter measure of liquidity by excluding inventories. So it's critical for assessing things like short-term solvency. So we can see in both companies, or in MODG, there is like a small increase, and in golf, there's that small decrease following also the current ratios. They follow each other. Next, going a little bit into the profitability ratios, I chose three as for these. I chose the net profit margin, the return on assets, or ROA, and the return on equity, or the ROE. So the net profit margin indicates how much of each dollar of sales the company retains as profit after all its expenses. And then this is important because, like, if we see in MODG in 2024, because their net income was negative, we get this big giant negative percentage. And that compared to like golf, where their income may have decreased a little bit from one year to the other, but it wasn't as drastic as going negative income. And then we can also see that effect of having that negative income affect the return on assets and the return on equity, as they both take into account the income. The ROA measures how effectively a company uses its assets to generate profit, meaning that it helps evaluate the efficiency of operations, which in this case is really important because we can see that they are not being very efficient in their operations compared to that of golf, which they may have decreased a little bit in their income, but their efficiency is increasing over time. Now, heading on a little bit into the return on equity, it's important because it shows how effectively the company generates profit for its shareholders. So, as someone that wants to join in and more so invest in a company, you really want to focus on like the return on equity because that's how you're making your money back. So if you see this like MODG has this big giant drop off because they were not making money at all. So it would be more pointing towards like the golf because they do have an increase in the return on equity. Next, I want to talk a little bit about the market value ratio. So I picked three as well, being the earnings per share or the EPS, the price to earnings ratio, and the dividend yield. So the EPS is important because it shows how much profit is attributed to each share of stock. So as we see, MODG, it also takes into account the income. So their 2024 per share is negative, which is not good at all. But compared to that of Acushnet's holding or golf, we can see that they do have an increase per share per from 2023 to the 2024 year. And that flows into the price per earnings ratio, which shows how much investors are willing to pay for each dollar of earnings. So if you were to look up the stock price for MODG or golf, it gives you the price to earnings ratio given to them by like Yahoo or Google Finance. But it won't show the price to earnings ratio for MODG 2024 because they are in the negatives right now. So they are not making money. But this would show you what their price to earnings ratio would be if they would show you, which it would be negative 1.19. Next, heading over to the dividend yield. This is kind of important because it's like how much the investors are being paid out each year. So it indicates the return shareholders receive in dividends related to their stock price. So because MODG did not make money, they did not pay out dividends in 2024. And in 2023, they did not either. And compared to that of golf, they paid out about 78 cents per stock price. And then in 2023 and then 85 in 2024. Now going into a little bit of the coverage and leverage ratios, I chose to look over the debt to equity ratios, the times interest earned ratios, and the debt to asset ratios. So breaking down each one, the debt to equity ratio shows the portion of debt financing relative to the equity. So this is important because it shows how much debt compared to their financing they really have. So like MODG in 2024, we know that their income was negative already. And it just shows again here how they have a lot more debt compared to that of like golf, which they do have positive income in 2024. Now heading into times interest earned, or TIE, it shows how many times the company can cover its interest obligations with EBIT. So this basically is telling us that um, sorry about that. It basically is telling us how many times a company can, yeah, cover its interest. So if the company were to, like, let's just say fail and they need to pay back that money in interest, how many times are they able to do that? And we can see how that affects a company. So like MODG, they are not able to do that because they were not profitable. But golf, they were able to pay back their interest obligations 5 times that amount in 2024 and 6.9 times in 2023. Going to the debt to asset ratio, it's important because it measures the portion of assets financed by debt. So it basically tells you how much of their assets are due to debt. So we look at MODG and golf, they are very, very close to each other, but they are two very completely different. Because if we were only to look at that, it wouldn't show us, like, for say, the times interest earned, because we can see that even though their debts are similar, they would not be able to be paid out similarly because MODG is in the negatives for 2024 and golf would be in the positives for 2024. And now I'm going into the DuPont analysis. The main one I want to talk about is the ROE, or the return on equity. And this is extremely important as the DuPont breaks down the return on equity into three categories. It's the net profitability margin, the asset turnover, and the equity multiplier. So this is used to identify what drives profitability and what's driving it either positively or negatively. And in this case, we see that the ROE of MODG in 2024 was negative, but the main factor that was driving it down was the net profit margin. So they were, because they did not have any profit, that drove them down way significantly compared to that of golf in 2024. And lastly, but not least, we're going to look at the Altman Z score. So this is very, very important because this is telling us if a company is about to file bankruptcy. So it predicts how likely it is for this company to go bankruptcy. And if, as we can see here, golf is at a 4.19, and anything above a 2.99, you're considered in the safe zone. So a company is not as likely to go bankrupt. But if you go over and look at MODG, you can see they're at a 0.301. And anything less than a 1.8, you are considered in the distress zone, meaning that they are highly, highly likely to file for bankruptcy. And this is really important because if you are an investor and wanting to invest your money in a company, you really, really need to be looking at things like this because it can tell you if you're what will happen to your money, basically. So if you were to invest, for say, in golf, your money would most likely be safe. But if you were to invest in MODG, you might be a little bit more hesitant to invest because a company like them in with a 0.301 Altman Z score is more likely to go bankrupt. So a little bit about the final thoughts. Um, my recommendation to an investor would be to invest in Acushnet in the 1 year and 5 years, but I wouldn't for Top Golf Callaway brands as they have been on the downwards trend. And as we saw in the last portion, they might be going bankrupt. We do not know. But overall, I think it would be a safer way to put your money into a Kushnet than it would be to put it into Top Golf Callaway. Thank you.